right, thank you guys very much for coming out. My name is Mark Mullin, and I will have the distinct pleasure of closing out today's tax camp with you guys. I will be covering multi-state taxation. Before I begin, some of you guys might just be thinking that, multi-state taxation is just the little brother of international tax, and we already went over that. I'm going to emphasize now that there are two key differences, and this presentation will hopefully really emphasize them to you. The first is that state tax focuses on the unitary business doctrine in a lot of ways. This forcibly combines corporations into a single entity. You'll see this brought up a lot. And the other big thing is that international tax is sort of standardized by convention and treaty, and state tax instead, we use the Supreme Court. So it ends up having a very distinct feel, and I think you guys will appreciate the differences. So to begin with, before I get underway, let me note that state income tax tends to use exactly the same measures of income as federal measures and same entities. They usually will adjust it back from federal measures to get rid of some of the bonus depreciation and other things that the federal government gives you that are nice. As always, with anything in state and local tax, there are exceptions. There are states that have different definitions of entities and what's disregarded and what's not. So you have to keep an eye on that. But for now, just generally assume this will be the same as federal. So this presentation will proceed by sort of going through a general analysis that you might go through for state and local income tax. I'll also discuss sales and use tax very briefly. The first thing that you're going to do in state and local tax is you're going to establish the units that's being taxed. There's the unitary business approach and the separate entity approach. The second thing you're going to do is see if states have nexus to tax the income. Nexus basically means that the states have close enough connection to the income or the person earning the income to tax it. The next thing you're going to do is separate your income into the allocable portion and the apportionable portion. You'll see that these are treated differently. If you're not familiar with state and local tax, allocation and apportion are terms of art. And then you're going to apply the allocation rules, the apportionment rules, and finally we will end by saying how you can argue that the state has given you an unfair apportionment. So we're going to begin with the taxable unit. To sort of get your mind around this, if you're unfamiliar, it's good to make a comparison to how natural persons are taxed. Countries and jurisdictions have a choice. You can tax individuals as the taxable unit, or you could tax a family. You could say that kids and parents are one or just a couple, or as in the US, you can tax in sort of a hybrid way. We allow married couples to sort of file like individuals separately or jointly, and it sort of gives a different flavor. What makes state tax very different from international tax is that corporations, it asks the same questions for corporations. Should we tax corporations as though the group is one taxable unit, or should we tax each corporation separately? So those are the two approaches. If states respect the legal boundaries between business entities, they're following the separate entity approach. This is tied to allocation of income, which I will discuss later. This is basically how international tax works. All money is going to go to one jurisdiction. You're going to respect the fiction that all these entities are really distinct things. The other approach you can do is the unitary business approach. This is tied to apportionment, and what we're doing, again, is forcibly combining corporations into one single business. There are hybrid approaches as well here, just like the separate filing for marriage under federal law, and I'll go through that as well. So the separate entity approach. I'll give you examples so you know how the separate entity approach works. It's really what you guys are familiar with, so this is not going to be any earth-shattering stuff. If Corporation A in a recognized transaction exchanges properties with Corporation B, they will get income or losses from the transaction, and they will be the only ones that will get income and losses from the transaction. The transaction will be sourced solely off of the transaction characteristics. There's a lot of upsides to this. This is very simple. It feels accurate, but the downside is something that Roger brought up. There's a need for an arm's length standard when you do separate entity approaches. For example, if a buyer buys from an unrelated seller, you know that they're going to negotiate fairly. This is because if the buyer overpays to any degree, they'll lose that value forever. If the seller undersells the product, she's lost that value forever. Therefore, you can guarantee that all value's been transferred and that this method will accurately account for the values that have been transferred. But if these parties are related, of course, say the buyer buys from a closely related seller. If the buyer overpays, that's okay because they're close. The better off the seller is, the better off the buyer is. They're both happy that way. So therefore, separate entity accounting sort of breaks down when parties are related because the value of the transaction isn't fully reflected in the amounts being transferred. So this, of course, is one of the key issues of international tax with transfer pricing and whatnot. If this isn't addressed, it just invites related entities to shift all their income to the most tax-favored entity. So if, for a very basic example, if entity A has a high tax rate and entity B has a low tax rate, the two are related, B would do well to license IP to A. Now, when A pays the royalties from that license, it will get a big deduction, and that deduction will be worth a lot because A has a high tax rate. B, on the other hand, will get a low value inclusion. So this is a big problem for the separate entity approach, and I'll discuss this later when I discuss allocating income because the two have a lot in common. So now let me compare, on the other hand, the unitary approach. And again, this is what makes state tax, in my mind, really special and interesting. Think, for example, there are three corporations, Corporation A, B, and C. They all run a single unitary business together. That's a defined term I'll get to later. And now one of those corporations, A, trades property with a corporation D. Now let's say D is part of the unitary business. What the unitary business approach says to do is disregard the transaction. You're just moving stuff around within the same entity, the same business. If Corporation D is unrelated, then all of Corporation A, B, and C will be considered to earn some degree of income, even though, from a legal formal perspective, only Corporation A was involved in the transaction. The reason for this is that, in substance, under the unitary approach, the business is what is earning income, not the legal entities. I should note before going on that even though here I talk a lot about how you can combine corporations to make a unitary business, it's in fact possible to go the other way. Corporations can be comprised of multiple unitary businesses, and that's we'll disregard that matter for now because that's less common. So the upside of the unitary business approach is that for related party transactions, it's a much simpler thing than having to worry about transfer pricing and all these other different anti-abuse rules that come with separate entity accounting. There's no artificial determination needed of residency for a corporation. I happen to think that makes a lot of sense from a policy perspective. It doesn't make any sense that a corporation has a residency. There's no need for foreign tax credit if you have a pure unitary system that's worldwide. And so there's a lot to recommend there from a policy perspective. On the downside, it's not a standardized area. You'll see some of the problems with that. Another downside is you have to do the separate entity rules anyway. You're doing that for the federal government and internationally. So you're basically being asked to do your accounting sort of two different ways. And that can be a pain. And next, and as I'll show on the next slide, the unitary business concept is really imprecise. Again, a unitary business must be shared among legal entities for them to be forcibly combined into one taxable unit. But no one knows what a unitary business is other than a sort of common sense gut feeling. The Supreme Court has given us this wonderful list of indicia or indicators that a unitary business exists. Things like functional integration, centralized management, and all that sort of good stuff listed here. States also will often add like more bright line rules that there has to be at least 50% common ownership for them to be combined. But really at the end of the day, it's hard to know, if a company manufactures widgets and then idgits, some other strange product that they have, is that one business? Maybe, it's hard to say. And there's a lot of discussion that, if you're a little cynical on this, the perspective is what is a unitary business is whatever gets the state the most income. So you might ask yourself when, if you really start thinking about the unitary business concept, like, wow, is there really any limit to this concept? Say I have a multinational client. They operate a lot in like a third world country, and that country happens to be very cheap. Everything is cheap. Under unitary, we're comparing kind of apples and oranges if we think of them as all one company. They're in very different economic climates. This might not be a fair way to look at one company. The Supreme Court has said it does not care one bit about that kind of argument that's been made. Even though the Foreign Commerce Clause, as we'll discuss, has higher protections for foreign commerce, the ruling is that states are allowed to unitize all of your business no matter where it is in the world. But states have restricted themselves because corporations are very good at lobbying, and so they will have different rules which will restrict the unitary concept by boundary, by jurisdictional boundary. So the nexus concept is they will only unitize businesses that they have nexus to. That nexus is what I'll describe in my next section. The next approach is water's edge. Only your domestic entities will be unitized into one business. The next is tax haven. It's basically a punitive version of the water's edge. Only domestic entities, plus if you have some business over in some tax haven country like Ireland that we don't like, that's also unitized too, sorry. And then lastly, there's the worldwide approach. This has gotten out of style, but it's coming back because everyone wants more money, as in the states want more money. So we may see more of that yet. So while I'm describing this, I am going to make a clean break between separate entities kind of approaches and unitary approaches. But again, this is kind of misleading. Really, states tend to fall in some sort of hybrid of the two. So ways that the state might make a unitary approach more like a separate entity approach are listed right here. For instance, states might let you do separate reporting. This means that you don't actually have to combine different corporations into a single unitary business. Really, this is the worst of both worlds for the states. No, I don't know why they would ever do this to themselves, because it allows you to structure your company, structure your corporations in such a way as to get the best of the unitary business approach. And then, if the unitary business approach isn't going well, make a corporation, and then you basically have the separate entity approach at that particular point. It's not a great idea for the states. It's great for us though. Another thing that they might do, again, on the previous side, you can limit unitization by jurisdictional boundaries. And one thing that the Supreme Court has done that's really sort of made unitary business a little bit more limited than it should be is that some income has to be specifically allocated instead of apportioned over the entire business. I will explain those concepts a little more as we get there. So whenever unitary approaches become more like separate, those problems, that arm's length problem that I was talking about, is going to come back and bite us. And by us, I mean the state governments. We're the beneficiaries of all these rules when they don't work well for them. On to the next topic, which is nexus. So states, the general idea of nexus is this. It's a very simple idea. If your property, or your income do not have a close enough connection to the state, it shouldn't be able to tax that, whatever it's trying to tax. In constitutional legalese, it said, the state must have substantial nexus per the due process and commerce clauses to whatever it wishes to tax. So that's all we mean when we talk about nexus. Now it's worth noting that you might think that nexus is a single standard idea across all the different kind of corporate rules that we have. Not at all. Sales tax has a different kind of nexus than income tax. And in fact, your need to register as a foreign corporation, totally different standard, although we don't cover that here. So sales tax nexus requires beyond a minimal amount of in-state physical presence. And then you can be subject to sales and use tax by the state. That's according to the case Quill versus North Dakota. So states have tried to expand this. They have held that if you have an affiliate in the state, you will have physical presence too. If you have an agent in the state, you'll have physical presence too. In fact, a very interesting case called the click-through nexus approach. So is this Amazon versus New York State Department of Tax and Finance case. There, Amazon, to get some advertising, made a program where it paid bloggers to put links to Amazon. A New York blogger did this, made a lot of money. New York claimed it had sales and use tax nexus over all of Amazon, and indeed it did. It won. So the reason that Quill says you need physical presence is basically the principle of stare decisis. The Supreme Court previously decided that way, and they didn't want to change their minds. But they only decided this way for sales and use tax. So for income tax, there's no real need for physical presence because there was no previous ruling that income tax was bound by physical presence. Instead, what the Supreme Court requires for income tax nexus is income must be meaningfully attributable to in-state activities, and there must be some definite link, some minimum connection between the state and the activities that are being taxed. What states have really taken this to mean is that what they need is economic nexus. Basically, if you have enough economic things happening in the state, they'll assert that they have jurisdiction to tax you. California, for instance, says if you have so much payroll in the state per year, so many gross receipts here per year, you own so many things here, then they have income tax nexus over you, and they will go after you. Another thing that states will do, again, is that they will tax you if you are closely related to someone who has economic nexus to the state. Now, an interesting quirk of state income tax law is an old law called, well, 30 years old, so I don't know how you guys feel about calling that an old law, but Public Law 86-272 came out at a very interesting moment in time. So back in the day, the Supreme Court said that you could not tax interstate commerce, one iota, which was a pretty ridiculous stance. They had a lot of very ridiculous cases where if you shipped a product through a state but never unboxed it, then it was interstate commerce. States couldn't tax it as long as it was in the box. A whole bunch of really stupid rules that thankfully are gone. But the court started moving very sharply in the other direction and basically let all of interstate commerce be taxed. Businesses were shocked and surprised. They had been relying on these kind of plans to avoid interstate taxation. So they lobbied Congress. And what did Congress do? It passed Public Law 86-272. Under this law, states do not have nexus to net income tax you if your sole in-state presence is that you have solicitation of orders by employees for tangible goods and activities entirely ancillary to soliciting such orders, where such orders are sent and accepted from out of state and goods are shipped from out of state. Said more simply, if your only presence as a corporation in a state is that you have salespeople doing salespeople things, then they do not have economic nexus to tax you. It should be noted that this entirely ancillary standard, no one knows what it means. It's completely confusing. The one Supreme Court case on point said, extending a line of credit, that's entirely ancillary to having salespeople there. But if your salespeople replace stale products, that's gone too far. That's not ancillary. So no one knows what the law is exactly. It's a very strange thing. So the law is meant to be temporary, and the federal government was going to take over state taxation. That never happened, and we have the system we have now. So we've now discussed the basic taxable unit idea and the need for nexus for a state to tax you. Now I'm going to start talking about how under the constitutional rules, states need to break down your income into an allocable portion and an apportionable portion, which is fun to say. So here's the required constitutional distinction. Investment income must be allocated. Allocation means you use source rules, like an international tax, to put an item of income 100% in one jurisdiction. On the other hand, you can apportion operational income of a unitary business. Apportionment means that you use a formula to estimate and divide income over multiple jurisdictions. I'll give you some examples of how that works. So an interesting note is though you have to allocate certain income, you never as a state have to apportion income. So this can actually, states love to abuse this in effect. Here's an example of a case where a taxpayer sells an item, Delaware considers it an allocable item of income, so it was due, 100% allocates it to Delaware. Delaware taxes that fully. Now, Pennsylvania considers it apportionable income and taxes 50% of it again. So that the taxpayer lost trying to fight that. And this is just something that states will do. If they have, a lot of natural resources, they will tend to allocate it to themselves. Because at the end of the day, you're going to come and you're going to pay the taxes, and they know it. So those are the basic ideas of dividing income into the allocable portion and the apportionable portion. Now I will discuss how allocation works in more detail, and then I'll move on to how apportionment works in more detail. So allocation works like this. If income is allocable under relevant state law, you just sort of use whatever arbitrary or semi-arbitrary rule that the state uses to source the income. I happen to think that sourcing is, after a point, it's a very difficult proposition to make sense of. Say you sell something to someone in another state. Where should that sale be sourced? Should it be sourced to your residency? Should it be sourced to the buyer's residency? Should it be sourced to where the title was transferred or where you negotiated for it, or even where the product was made? Sourcing sort of tries to get at the idea that they want to tax income from where it was made, but it's really hard to pin that down, and allocation suffers from that. The jurisdictional effect of allocation. So under conventions that have come to be born in international law and have been imported into state tax, primary taxing jurisdiction goes to a source state. That is, if a state allocates income to itself, it has primary jurisdiction to tax it. I'll explain what this primary and secondary means in a moment. Secondary taxing jurisdiction goes to the residency-state. So a residency-state doesn't think that the item of income should be allocated to it, but it thinks that it has, that the taxpayer is a resident of that state. So it claims the right to tax all of that resident's income worldwide. So what does that end up meaning, being primary and secondary? Well, the idea is that the residency state has to make way for the source state. It has to give a tax credit or other aid to the taxpayer to sort of help them with the fact that they paid tax in the source state. And the source state just can tax it however it wants, essentially. The primary, secondary sort of taxing jurisdiction has been, at least in international law, more of a convention. But actually, in recent state tax cases, there's been some movement towards the Supreme Court actually making it a constitutional requirement of allocable or separate entity kind of approaches. In Comptroller versus Wynn, this is a natural person income tax case. I figure the reasoning would carry over, but who knows. There, Maryland had its residents who would work in another state and earn income there only got a partial tax credit for the income that they earned in other states. The Supreme Court said that that was discriminatory and unconstitutional. They needed to give a full tax credit to be okay under the Constitution. In contrast, well, not in contrast, another case in a similar vein is Kraft General Foods versus Iowa. There, Iowa didn't have any foreign tax credits at all, but otherwise followed federal tax law, and it was a separate entity state. So what this meant is that local companies, US companies, got dividend received deductions, and companies that were getting dividends from abroad were getting no dividend received deduction, because we don't have that for foreign companies generally under the federal income tax law, but they were also not getting a foreign tax credit either. The result is that this was unconstitutional. It was held to be discriminatory against foreign commerce, even though it was all Iowa was doing for the most part was following the federal tax law. So as I mentioned earlier, there's that separate entity approach and the unitary business approach. So separate entity accounting and the approach is very deeply tied to allocation. I don't think there's necessarily a lot of benefit in keeping them separate in your mind, but basically separate entity approach and the allocation approach use the same sort of jurisdictional sourcing rules. And because these two are so closely linked, this means that the sourcing rules I discussed for allocation also exacerbate the arm's length problems that I discussed earlier for separate entity taxation. So for example, B and A are related. Entity A is in a high tax jurisdiction and entity B is in a low tax jurisdiction. So B licenses A IP rights at a high royalty rate, like before. Now the sourcing of the income is going to be in the jurisdiction where B is located. So the result is that A is going to get a high value deduction and B gets a low value inclusion. And yeah, so we have that particular problem. I'm going to go over now over the solutions that governments have attempted to impose to make separate entity and allocation rules work. So as we discussed earlier, there are the transfer pricing rules. Roger went over these in some detail. States follow suit. So for separate entity and allocation type income, you're going to go through very much the same exercise. The general concept, again, is that you're going to find comparable transactions done at arm's length price and use them to set the price of related party transactions. As Roger noted, the more common way to do this is to go through the comparable profits method as opposed to finding a specific transaction to compare it to. If the related parties don't observe the transfer pricing rules, the tax authority can reallocate your income and then also apply a pretty serious penalty unless you made a study. Now, the thing with transfer pricing is that internationally, most governments would agree it's been kind of a failure. It doesn't protect your tax base at all as a government. This is because it's too subjective. What is the best method? What kind of adjustments do you need to make income or another transaction comparable? This is especially worsened in the areas of intangibles. Companies make very unique intangibles. It's very hard to find a good comparison for them. So after a while, companies make up some pretty extravagant claims as to what the right royalty rate is, especially early on when IP doesn't have a value, usually until years down the road. The second solution, and this one is very particular to states and not common in international law, are the Addback statutes. So I gave you that example before of entity A in a high tax jurisdiction licensing from B, which is in a low tax jurisdiction, and thereby we are shifting income to entity B in that low tax jurisdiction. And the result is that A is going to get a high value deduction, B is going to get a low value inclusion. Together, collectively, they have reduced their taxes. This is common, and you can do this with all sorts of intangible expenses like interest, different sort of intellectual property type deals. So what an Addback statute does is that it denies the deduction for certain intangible expenses paid to a related party, just immediately denies it. More specifically, the analysis is two parts. First, you try and see if the expense is of a general type that will be denied. Any IP acquisition related expense, interest, licensing, fees, those are all hit by an Addback statute if they're going out of state to a related party. The second step is to see if there's an exception that applies. The exceptions generally aim at one single question, which is there convincing evidence that you made this expense for a good non-tax reason? You can look at business purpose, whether there's enough taxation or potential taxation on the related party's inclusion, and other sorts of evidence. An interesting fact is that Delaware actually has a corporation that seems to exist entirely to take advantage of these exceptions. For what it does is it will tax the inclusion fully on the other end for the related party, but it will give you a tax credit later. So you'll get the exception for the Addback rule, and then you still don't really pay the tax in the end. Beyond Addback statutes and arm's length transfer pricing rules, states have done other things to attack sort of shifting of its base. One thing is to assert nexus over whoever you're paying to. States will do this pretty willy-nilly. If they feel that you're abusing them, state courts aren't very nice. They don't really care to follow the rules so much as their gut in that particular situation. And they will also disregard transactions as lacking substance. Now I'm going to discuss how apportionment works. And again, this is one of the keys to state and local taxation that makes it distinct from international taxation. So the idea of apportionment is basically this. If Corporation A sells an item to B, to what source does the income really due? Again, as we were discussing earlier, is it the labor that made the item? Is it the assets? Or is it the sale itself, or even the marketing? No, it's really hard to say what makes the income happen. It's really somehow these things are combined and all of a sudden you have income. So what states do for apportionment is that they make a sort of rough estimate using factors that are easy to locate geographically. So more specifically, the process is you create a ratio to apportion the unitary business's total apportionable income. I'll give some examples of these. They make the idea, I think, easier. I know that these are a lot of equations, but it should help you get the idea generally. So the first example is market-based apportionment. It uses what's called a sales factor. So you're going to take the unitary business's worldwide apportionable income, and you're just going to multiply it by basically the percent of the sales that occurred in state. That's it. And then that's the amount that the state will tax you on. That's going to be your taxable income for the state. A second way to go about it might be to use production-based apportionment, where you're going to use production-based factors. Here, again, you're going to take the unitary business's worldwide apportionable income, and you're going to multiply it by the percent of property that the business owns that's in the jurisdiction, plus the percent of the payroll that that company pays that's in the jurisdiction. You're going to add them together, and you're going to divide them by 2 to make sure you don't have a ratio that's over 1. And finally, example 3 is where you combine market-based apportionment with production-based apportionment. So that's the basic ideas. It's sort of a rough and ready approach. There are some abuses that those formulas are adjusted for certain kinds of tricks that you might try to pull. Under Public Law 86272, for instance, it's possible to sell into a state without being subject to tax there. Now, if you're selling that product from a state that also isn't taxing the sale, you've created nowhere income for state income tax purposes. Neither state is taxing the income, and what this does is that this messes up the formula. Because what happens, we're just going to look at a market-based formula up top, so just ignore the bottom 2. What's going to happen is the worldwide sales figure will go up for all jurisdictions, but no jurisdiction is going to have a corresponding increase in the in-jurisdiction sales. So that's distortive and somewhat states feel that is unfair. So there are 2 solutions that states have come up with for that. One is that if a sale is shipped from state X and it's not taxed in the destination state, then state X, under a throwback rule, will increase the sales factor's numerator by the amount of the sale that was not counted. The other approach, so in other words, it's just going to increase the top of that sales factor to make sure someone is taxing that income. And then the other approach is a throwout. And what they're going to do is just remove it from the worldwide sales factor on the bottom. So they're going to get rid of it from the denominator. Yes?
The throwback and throwout rules typically only apply to sales of tangible personal property, I think. When you have a service business, like a SaaS company, that, let's assume for the moment, is treated as a pure service company, has no nexus, not even economic nexus outside California, but it has customers in those other states. You use 100% sourcing to California under the single factor sourcing rule, even without the throwback, or do you apportion theoretically to the other states, even though there's no nexus? How does that apportionment sort out for California?
If it doesn't have economic nexus?
If it has no nexus, no economic nexus anywhere, it's treated as a service business. There's no throwback per se.
It depends.
If it's an apportionable business, you would think they should apportion.
Yeah, I mean, you would think that they should apportion, and I guess it really depends on the throwback and throwout rule in particular. I guess generally they are written to cover tangible goods being sold from one place to another that are not counted. It should still be under apportionable income unless an exception is written specifically into the state. And I'm not aware of any, but I'm not sure on that.
The company would be considered a multi-state taxpayer, I guess, for purposes of California apportionment trigger, but it would not be subject to tax in any other jurisdiction, so it wouldn't actually be filing there. And it would consequently apportion, I guess, rather than showing as 100%.
Yeah, I guess I would need to look and yeah, that makes sense. I would have to check again over what triggers the multi-state and apportionment formula for California. All right, so continuing on with formulas, I'm going to go over the sort of general trends and standards for what's going on with apportionment formulas. Originally, the preferred formula was this 3-factor formula back here. And that was just sort of seen as a nice sort of even-handed way to distribute the income and say where it came from. States increasingly prefer the sales factor only formula. The cynical reason for this is that this taxes out-of-staters more heavily. They're not an important voting demographic, and it's kind of an inducement to start your business inside the state. Economically, states have a good argument, though, for switching to it, which is that the sales factor reflects the fact that businesses increasingly are more service and digital business, so property and payroll aren't really as big of a deal to them for where they're getting their money from. Unfortunately, one of the things about having apportionment formulas that are different between states is you can very easily, without proper planning, get yourself double taxed on income. For instance, say you have a company in state A and you're selling entirely to state B. So all your payroll and property is in state A and all your sales are in state B. If state B has a pure sales factor formula and state A has pure property and payroll, then each of them are going to tax 100% of your income. So that would be disastrous in that theoretical situation. Of course, if you flipped, if you had all your property and payroll in a state that only has sales factors, and you're selling entirely to a state that has no sales factors, you would have no state taxation in either state. Of course, pretty much every state will include some sort of sales factor, but as a hypothetical, it sort of helps you get your mind around the tax planning you can do in the multi-state tax arena. So the last thing we're going to discuss is how to argue unfair apportionment. This is where, you know, it's handy to get your lawyer. But the basic idea of arguing against an apportionment formula is this. Do one-size-fits-all formulas really make sense? States themselves kind of are moving away from thinking so. For instance, they're starting to tax a company like Netflix by an audience factor. That is, you're going to take their worldwide apportionable income and multiply it by the percent of their audience that resides in your state. So that can be one way to do your apportionment formula by industry. That makes sense. Now, you can always argue that an apportionment formula isn't fair to you. The Constitution actually requires that the apportionment be fair under the Due Process Clause and the Commerce Clause. States will make this easier. Under almost all state laws, there's a specific section that will let you get the remedy of a personalized formula just right for your business. State taxing authorities, by the way, can also use this provision to try and argue that the normal formula isn't right for your business. An interesting note on this is that all states agree if that you're arguing to change the formula, the burden is on you to show that the normal formula is wrong for your business. States do not agree that when a state taxing authority does it, the burden is on them. So that's something to watch out for. So how do you really argue that an apportionment formula is unfair? Well, the first thing that an apportionment formula has to do is it has to be consistent. Consistency basically exists as a stand-in for accurate sourcing, because as I've alluded to throughout this presentation, no one really knows what accurate sourcing is. So what you do is rely on consistency. Consistency under the Supreme Court's rulings has two parts. There's first internal consistency. So if the formula that your state uses was used by every state, would this result in more than 100% of the income of the taxpayer being taxed? Basically, if everyone did it, would it be fair? The second requirement is external consistency, which is a bit more of a gut test. The factors used in the apportionment formula must actually reflect a reasonable sense of how income is generated. Now, I note consistency in the arena of formulary apportionment, but actually consistency has been used in other areas of state tax law. For instance, that Wynn case that I was talking about that required a full tax credit for Maryland residents, part of that opinion is based on the idea that if not every state had that foreign tax credit, a full foreign tax credit, you would have double taxation. So that was ruled to be internally inconsistent. The second thing you have to do, or the second way you can go about this, is just show that formula is not fair. You can just directly argue that. To show an apportionment formula is unfair, you have to show it is out of, quote, all appropriate proportion to the business transacted by the appellant in that state. Now, the Supreme Court accepts that formulary apportionment isn't precise. So it has to be extremely wrong and feel extremely bad to the court under the standard for them to say that the apportionment formula is not fair, and you need clear and cogent evidence. State courts have been more forgiving. The Supreme Court cases are actually pretty interesting in how rare, especially over time, the taxpayers' victories are. So it's a little dispiriting, but then again, most of these cases are tried in state courts, and state courts do give the win to taxpayers much more often. So to go into this in more detail and just to lay out the strategy, to argue consistency in an unfair apportionment, the first thing you're going to do for your evidence is you're going to provide good accounting and econometric data to indicate the state is taxing way beyond any reasonable measure of what it could be taxing. Again, so an interesting thing about using accounting data, the kind that you would normally do for federal taxation, your separate entity accounting, is that the Supreme Court does say that that is material evidence, it's relevant. But the Supreme Court also says that it basically thinks that that's a load of crap. It's very skeptical of separate entity accounting because it doesn't think it really accounts for that sort of magical quality. Well, the better way to put it is the functional integration or centralization of management or the economies of scale that a big unified business has. That is one thing to note elsewhere. I don't really discuss it much here. But if you are upset with the apportionment or taxation that a state is arguing, you can argue that the business that they say is unitary is not unitary. That is a different approach. I don't discuss it because it doesn't tend to win very often. So the second step to arguing consistency or an unfair apportionment is you have to have a good theory as to why that formula doesn't apply to your business. For example, the formula uses payroll, but we only hire independent contractors. That makes no sense for us. It uses tangible property in the property factor, but we're all intangible based. Generally, the argument is we follow a new business model that this old-fashioned formula was not built to accommodate. The last note I will have on arguing apportionment is the idea of non-discrimination. So states cannot discriminate against intrastate or foreign commerce. You might think from what I said earlier that a single sales factor apportionment discriminates against out-of-staters, because in effect it kind of does. But the Supreme Court has disagreed because generally equal protection and non-discrimination concerns of that sort of variety tend to win less often in tax. So that pretty much wraps up the presentation. There's a lot of other interesting areas in multi-state that I was thinking of talking about at some point in the future. There's some good case law about the distinction between operational and investment income. And partnerships have very distinct treatments under the unitary business approach, differing wildly from state to state. So yeah, thank you very much for your time. And if you have any questions, let me know.